All right, so NASDAQ, this is our daily chart here. Take your attention up to this old high here, 12,339 even. Then the consequent encroachment of that wick, because wicks are gaps. What do I mean by a wick is a gap? The algorithm refers to a wick as a gap, and the gap will want to most likely be traded to its consequent encroachment, which is the midpoint of the gap. Not to be confused with a mean threshold, which is the middle or 50% level of an order block. Okay, so my order block theory and gap theory are distinct. They're very similar in some ways, but they're very different in others. All right, and over here we have two down closed candles, which is the bullish order block. If you look at the candle's high here to this candle's low, that's a buy side imbalance, sell side inefficiency. Fair value gap, but specifically categorized as a BISI, buy side imbalance, sell side inefficiency. The market trades down into it here and trades into the order block, the open to the high. So both of those levels here, be mindful that this blue shaded area is this imbalance from here to here on this single candle, and the order block are these two heavy blue lines, okay? All right, so here we are on the hourly chart, and right away your eye should go right to this clean level here, relative equal lows, and here's that daily buy side imbalance, sell side inefficiency right here, this blue shaded area. But it's aimed at this range from here to here. That's what it's showing. The order block high in the open on the daily chart, that's what these levels are here. So you can see how we ran up, took out the short-term high, broke lower. We have a high, low, higher high. Down closed candle is what? Bearish breaker. Trades below it, comes back up, bumps it, sell off. Sells all the way off to take out the sell side liquidity. And there's an imbalance here and an imbalance in here. All right, here's the 15-minute time frame. You can see the sell side liquidity pool here. Too clean. Smooth edges like to be made what? Jagged. All right, so here's the 15-minute time frame with the imbalance here. So we have sell side and the fair value gap. So it digs down into that, and it's also the low end of what? The sensitive price point of a bullish order block, which is the opening price, and the high. So it trades down into it, hits it, and then reacts. So let's take a closer look inside this area in here. All right, dropping down to a 2-minute chart. Why 2-minute chart? Well, to save time, and this is the chart that has all the details that you would have worked down through anyway. We have buy side here, smooth relative equal highs, smooth relative equal highs. Order block trades back to it here, sells off, trades into our imbalance, digs in to the lower end, which is the price on the down closed candle on the daily chart, which is the bullish order block. This is the high of the daily bullish order block. We trade down into it, taking out sell side here, and then trades higher, trades back down into a fair value gap after sell side's been taken, and a higher time frame order block has been traded to. The market rallies, trades above a short-term high, so now we have a shift in market structure. Fair value gap here, trades down into consequent encroachment between the candle's low and the candle's high here. Midpoint is here, and we have a bullish breaker. So we have low, high, lower low, take the body of the candle, uppermost candle, extend it forward, okay? You're doing it with the up closed candle, not the down closed candle when you're using bullish breakers. Extend it through, you can see we're finding some support in here, consequent encroachment, and you want to see gaps like that in this stay open. It would promote the idea that you may be seeing a breakaway gap. Market rallies back up into last up closed candle. This would be a breaker by any other definition, but because we are elongated from that high, in other words, it keeps stretching further, when we trade back to it and above it, it's mitigation. Okay, so what's being mitigated here? Any trader that's offside that was going long in here, they can mitigate that trade here. Order blocks and candles are not mitigating. Mitigating is the action of the trader that is offside. Order blocks and candles are not mitigating anything. Price is allowing the trader to mitigate their offside position, mitigating potential drawdown, limiting it or removing it altogether. So that was the function of mitigation. Trades down to it here. Also, we have a buy side imbalance, sell side inefficiency. This candle's high, this candle's low. We dip into that partially. It's supporting. Why didn't it all the way come down to this level here? Because of the mitigation block. Leave some of that open. Expect it to be institutional order flow entry drill, which is a partial entry to a fair value gap before resuming higher. The market reaches up into the buy side liquidity here, creates a bullish order block, trades down into it here, rallies, fair value gap, consolidates, accumulates more long positions, and then rallies away. What level is this accumulating longs at? At the high of the daily bullish order block wick. And then we have market rally up, order block retest here, and then continues to move higher. Afternoon session on NASDAQ. New York lunch begins and ends. Here's that run from the order block, and then the fair value gap rallying around the high of that daily bullish order block, wick high, rallies, another institutional order flow entry drill right there. I don't have that noted, I apologize. Fair value gap with an order block, trades into it here, rallies, order block, cut through candles, folks. Bullish order block rallies, another order block, 1, 2, 3. Why do I only use this one candle here, and why do I use all of these here? Because all of these candles here are going against order flow. Order flow is bullish. So if there's a series of down close candles and we rally through it strongly like we do here, go back to that original high candle, extend it forward. We have an imbalance, yes. We have a potential order block here, but I'm not interested in that. Why? Because the candle's body on this one goes lower than that one. There's rules, there's levels to all this, folks. The market drops into the order block, accumulates, rallies again, small little fair value gap in here between this candle's high and this candle's low, extend it through, accumulates longs here, 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 and then once more over here. Why? Because it needs to go higher. In that last hour trading, the macro runs from 3 o'clock to 4 o'clock, trades down to the order block. Everyone thinks the high's in place, pumps it through, clears out buy side. Rolling on over into E-mini S&P, this is our daily chart. We have the consequent encroachment of this wick, 41.17 3/4. Consequent encroachment of this candle's wick, which is 4,072.75. Much like NASDAQ, we had accumulation from this original fair value gap here, bouncing, trading up to and stopping here, and then the market rallied through. Then we had this move here. Okay. Previous day, we had this small little candle, which is what? An inside day. Inside day because its high is lower than the previous day and its low is higher than the previous day. So we're going to get a large range day whenever we see this type of scenario. Now, I like the idea that we came all the way back down into this buy side imbalance, sell side inefficiency, this green candle here, split this candle's range between here and here. This is consequent encroachment. Drops like this, hits the consequent encroachment, completely algorithmic, and then reprices higher. Carrying those ideas and levels over into the hourly chart, you can see here, here's that buy side imbalance, sell side inefficiency, and the market rallied up on the pass through here, consolidated, relative equal lows, so you know what's going to be resting below that, right? Sell side liquidity. And we had a small little imbalance that's purple, it's hard to see it, I know. Then we have this one here, and then we have this one down here. It's better to leave this one open. Why? This is the part where you write down in your notebook. When you have a larger imbalance like this blue shaded one here from the daily chart, if I'm bullish, I want to see the majority of the reactions in the upper portion, which would be the premium level of the imbalance. But when you're looking for continuations, don't see this trading down to this level here in the upper portion, like I have here, the upper half of the fair value gap. That area here, a premium on a higher time frame level when bullish, when it trades back down into it, it creates what? An inversion. So premium becomes discount. You want to know the answers to why I know some of these imbalances are going to stay open, right? Well, I'm teaching it to you. The whole point is there are some imbalances that are going to remain open. Some, I want them filled. The ones in the upper half of this fair value gap on the daily chart, above consequent encroachment, I want to see those filled. It's even stronger if they don't fill in. But the ones on the lower half, they are likely to stay open. They're better to stay open. If they come down and fill in, then it's not as bullish. And the algorithm may chop around and consolidate longer, and then I have to wait for more information. But if I see these types of scenarios here, it's almost like a loaded deal. Like it's pretty much next to a sure thing that you're going to get a type of reaction like this here. Okay. And that's why sometimes when you see me trade, I can go right in there when it's just driving straight down like a falling dagger, and I'll catch it right when it's going into the lowest low, and I'll buy it right there, which seems crazy, but it's these types of scenarios that I do that in, when I can see what the framework is and trust that, you know, these areas down here won't be traded too. So we have an imbalance in here. Keep your eye on that pink area there. And then we have this wick, and let's dig into the perspective of this entire range from here to here. Here's equilibrium. So we are in what? A discount. So even though we're in the upper portion of that daily fair value gap in the form of a buy side imbalance, sell side inefficiency, that's that blue shaded box here. The upper portion of that is the ideal scenario for what? Lower intraday charts trading down into that, creating a discount. Okay, 15-minute time frame. You can see that we dropped down from the fair value gap over here. We went below the low here, went below it, came back up. Look how it's really respecting that. One more time here, consequent encroachment, midpoint of the pink shaded area, and then it acts as what? Real resistance, as it acted support here, right? If we go through it like we do here, it can come back up, and then what? We start to work down. This whole shaded area becomes what? A balanced price range. It's delivered both sides. down, up, and then left it. Come back in, consequent encroachment, that's the last line of defense, and goodbye. Next T plunge. Drops lower, creates a small little SIBI here, fair value gap, consequent encroachment, beautiful delivery down into our lower level hourly fair value gap. Digs into it perfectly here. Well, not perfectly, it went over by 1/4 of a point, so 1 tick. Then we consolidate here and then rallied up. Notice also this SIBI, project that through, and you can see we come back down into it and consequent encroachment once more. The rally's up, takes out buy side here, digs into the last up close, little change in the state of delivery here. Let's drop into the 5-minute chart. Okay, here's the 5-minute chart. Sell side liquidity here, digs below it, hits the hourly fair value gap, the one at consequent encroachment. Remember, we don't want to see the lower half of that daily buy side imbalance, sell side inefficiency, which is that big blue shaded area here. We don't want to see it trade down below consequent encroachment. We're focusing on the upper portion of that. Because if it's going to do its turn in here and start presenting all these arrays that we can time off a long or a shift higher in price, then it's better for it to do that there than to dig into the lower portion of that buy side imbalance, sell side efficiency on the daily chart. But I want you to take your attention in here. We have this candle here, and then this candle right there. See that? So the market reacts from the low end of the hourly fair value gap that joins and links with the consequent encroachment of that daily buy side imbalance, sell side inefficiency, the blue rectangle. It rallies up, creates a short-term high right there. And then this candle pierces it, creating, when this candle here closes, fair value gap right there. See that? So the market trades down into it here. Once more opens and then runs away. Order block, trades down, retouches it, rallies, consolidates, rallies again into our old shaded area, dips back down. It's going to be resistance here. No, we have now turned the corner down here. It rallies away and comes back down into the buy side of sell side efficiency here with the order block, trades to it there, rallies through, and presses into the afternoon 4038.75 level. On the 1-minute chart, you can see how we dropped from that 15-minute time frame fair value gap. We traded up into it here. This is a Judas swing after taking buy side liquidity and rode it all the way down into this level here. The market did, in fact, rally here. Look at this high here, right where the volume imbalance is. See this high here? This candle's high is higher than that one, and then this candle is lower than that one. This is your swing high. The market rallies through. That's a shift in market structure. But ICT, it didn't close above that high. I didn't say it had to. A shift in market structure does not ever require a close above a short-term high when it's shifting bullish. It does not require a close below the swing low when it's shifting bearish. So that shift here is bullish. So this drop down here, it's a suspect decline. It's a Judas swing in many ways. Where's it going? Fair value gap. It trades in consequent encroachment, midpoint. How nice is that? The market rallies, takes out the short-term high here, another fair value gap. That range extended through. It touches it here, 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 and it delivers like gangbusters. We consolidated in here, ripped through, took the buy side here, back into that imbalance on the hourly chart. An hourly break of continuity in price action during the New York lunch hour. You can see that here. We drop back down into the buy side imbalance, sell side inefficiency, hits the order block here. Beautiful rally. Accumulates at the low end of that old hourly imbalance, the pink shaded area, and fair value gap. Rallies once more. Market creates a decline in here. Order block, trades into it here, rips higher. Fair value gap, digs into it here with an order block. Rallies again, buy side taken. Here, false high, drops back down the last hour of trading between 3 o'clock and 4 o'clock. Order block, extended through. Why this one? This is the most significant price point. This one here. Last 2 down closed candles through this price action. Hits it here. Last hour macro comes in right when you're expecting it to. Rallies up, takes the buy side out. Bam! Hits the 40.38 3/4 level.